When you're looking to buy a home, a term that you may hear a lot is pre-approval. But what does that even mean? Once you've found your lender, getting pre-approved is the first step. Pre-approval allows you to start making offers on homes. It simply states that you'll have access to this much money and that you're qualified to buy the home you're looking at. But how do you get pre-approved? Well, it's kind of like making a burrito.
Do you think I want a messy burrito? No one wants a messy burrito.
The first step is saying, hey, I want a burrito. And we make it super easy for you. You can even order your burrito online. You'll make sure to provide fully accurate information, of course. Chicken or steak? Where do you work? What's your credit score? Do you know that guac's extra? And plenty of other questions and qualifications. Then you'll simply hit submit. Now that you've submitted your application, we build the burrito, or your loan offer. Your loan offer tells you exactly what you can expect to pay for the home. This is your mortgage coach. They are a foundation to a successful burrito. I mean, the home loan offer. They keep all of the ingredients together and wrap it up nicely. Oh yeah. This is your down payment, which means the percentage of the home's worth that you're paying for up front. Depending on the type of loan, you can either have little to no rice, or maybe you just want to pile it on like we did here. Now this is the type of loan you're getting. There are options like Black Beans, Pinto, FHA, Conventional, VA, and so many other options. This is something that you want to make sure is right for you. This is your typical mild, medium, or spicy situation right here. Are you going to pay off your home in 30, 20, or 15 years? Here, we have the mortgage interest rate and mortgage insurance, the extra cost of financing the home instead of paying cash. And the cheese? It's your closing cost. One of the final steps to make sure you can get into your home. Last, your escrow fund requirements. This holds funds for your yearly expenses such as taxes and insurance. And now, we just gotta wrap it all up. While I may not be able to wrap the perfect burrito, Dash can wrap up the perfect loan offer. All the information should be clear and easy to understand. At this stage, you should have questions and should absolutely clear up anything that seems confusing with your lender. But right now, I'm sure you still have questions. So it's time for Tiny Mike Big Questions. First question, when should I get a pre-approval letter? Well, now, or yesterday probably is what your real estate agent would tell you. How do you know what houses to even look at if you don't know what price range you're approved for? That's number one. Number two, no seller is gonna take their house off the market for someone who's not pre-approved because they need to know that the person who buys their house can actually afford to close on it. You'll give them that piece of paper, it will tell them that you're fully vetted out, and you'll have peace of mind knowing that you can close on the house that you're under contract on. Question two. What does pre-approval really mean? Pre-approval isn't a guarantee of the loan. It means that your lender has verified your information and that they have made a loan offer to you. They provided information also about the fees and the costs to borrow from them, so you're up on that. And they also commit to lend you as long as none of your information changes. So don't go changing jobs or applying for a credit card or doing anything that would affect the information that you provided because it could put your loan in jeopardy. And one more thing, it also has to meet the requirements for the property, such as appraisal and condition of the house, etc. Question three. How does pre-approval fit into my to-do list for buying a home? The good news is it's a great step towards buying a home, but the bad news is that while that is the case, there's still a lot left to be done. So you might be asking yourself, what all is on that to-do list? Due diligence fees. So this is a fee that you're gonna pay the seller up front to go under contract on. The reason why the seller wants this money up front is because they're taking their house off the market, so no other potential buyers can buy the house. Once you sign that contract, you have the exclusive right for a period of time that could extend 30, 45, 60 days, or even longer. So if they're gonna take the house off the market, they need to know you're serious. So the due diligence fee, in general, will be non-refundable fee up front that you pay. If you back out of the contract, they get to keep the money. If you close on the house, it will go towards your purchase price. Earnest money deposits. Earnest money deposits are given at the same time as a due diligence fee, but there's a little bit of a difference here. The money is not automatically the seller's if you walk away. The money is held in trust at an attorney's office. You have a due diligence period to do inspections, appraisals, and other things on the house before you decide that you're actually going to go through with this purchase. If you back out of the contract before the due diligence period ends, you get that money back as the buyer. But once you pass the due diligence expiration date, you've committed to buying that house. And if you walk away at that point, the seller gets to keep the earnest money. Escrow. When you make your monthly principal and interest payments, most lenders will also require you to make escrow payments as part of your monthly payment. It's for your taxes and your insurance on the property. Tax bills and insurance bills come due annually, and they could be pretty large expenses for the average buyer. So instead of having to save up thousands of dollars throughout the year of your own, part of your monthly payment will be put in your own personal savings account that the mortgage bank keeps on your behalf. And then, when those expenses become due, they'll make the payments on your behalf. This gives you peace of mind, so you know you have enough money to pay those bills, and it gives the bank peace of mind because they know that there won't be a lien on their asset that they have a lien on as well. Escrow can also refer, in some states, to the period of time in which you are under contract but have not yet closed. They will say you're in escrow. Home inspection. A home inspection is what a potential home buyer will get once they're under contract but before they've passed their due diligence period. This is to find everything wrong with that property. The home inspector will check out every nook and cranny. They'll tell you things from dents in the walls to the roof is leaking. Once a buyer is armed with that information, they will have enough information to go back to the seller and ask for some repairs to be done on their behalf, or if the repairs are too major, perhaps they'll walk out on the house altogether. Home repairs. Piggybacking on the home inspection comment, the home inspector will bring to light a bunch of repairs that need to be made on the house. Keep in mind, no house is perfect, and every house will have tons of repairs to be done, and it'll be a project from when you buy the house to when you sell it again. Some repairs are so major, though, that you will want the seller to fix them before you agree to move forward with the purchase. And some repairs can be so big that you decide to walk away from the purchase altogether. Appraisal. Yet another thing that you'll have to get done during your due diligence period. The appraiser will go out to the property and assess the condition and the value of the property. The value is super important because in general, most home buyers won't want to purchase a property that's worth much less than they're paying for it. In addition, a bank will only lend on what the property is worth, not what you're paying for it, because they have to protect their asset too. Remember, the bank has a lien on the property, so it's just as much their house as it is yours. Settlement date. The settlement date is the agreed date that both parties aim to close on. When you write a purchase contract, one of the negotiation terms is settlement date, because both parties need to plan on when the transaction will finalize. You'll need to move, change utilities, maybe even change jobs if you're moving across the country. While a settlement date isn't set in stone up front, both parties must work in good faith towards that settlement date. You're going to be most successful during the home loan process by working with your lender, getting them information quickly, and staying in contact with them. Getting pre-approved is an important step, so let your lender help you along the way. And if you're interested in Dash being your lender, check out our website for more details and how to apply.